the best of Money Matters.
Market View on Money FM 89.3.
You're listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. The SCI closed down at 0.6% at 4,230 points. Looking across Asia, China's economic momentum appears to be slowing. Factory output grew 5.7% year-on-year in July, marking the slowest pace in 8 months, while retail sales rose just 3.7%, the weakest increase since December 2024. Meanwhile, Japan delivered stronger than expected GDP growth. Its second quarter GDP rose 1% annualized, boosted by resilient exports and capital spending, while private consumption edged up 0.2%. Shifting to the U.S., producer prices in July jumped 0.9% month-on-month, the largest increase in 3 years, driven by broad-based gains in both goods and services. And on an annual basis, the PPI rose 3.3%, up from 2.4% in June. Now, for more market moves and views, joining us today is Benjamin Goh, Head of Research and Investor Education at CS. Hi, Benjamin. Welcome back to the show and happy Friday.
Hey, Alex. How's it going?
Doing great. Let's start with the SCI, Benjamin. So it opened at 4,236 points today. What do you think drove market sentiment? Any major movements being led by specific sectors?
Well, if you're talking about the big caps versus small caps, the big caps led the decline at a negative 0.82%. That's kind of half of the cost for this kind of, pre-weekend kind of market trading activity. The biggest hits were from companies in the education and electricity and gas sectors. We're talking about the local banks on an ex-dividend basis. The prices of DBS and UOB closed down 1.17% and 2.81% respectively. So fairly large numbers, but it's fairly normal for stock price to come off once the dividend is paid out, or if the stock price does not include the dividend anymore. So that's pretty normal. So generally, it was a risk-off market sentiment today. Investors were generally trimming their positions ahead of the weekend.
Now, moving over to China, its factory output grew 5.7% year-on-year in July. It's slowest in 8 months. And while retail sales rose just 3.7%, the weakest since December 2024. What does this slowdown tell us about the state of China's recovery?
Well, certainly China's economy still faces quite daunting headwinds. So you've got a couple of things at play. So if you look at the negative wealth effect, that's still very much in play, simply because the decline in property values still wearing down domestic consumption. So the general idea is that if your stock portfolio and your property price is up, then of course you feel happy, you feel wealthy, and then you go out and spend more. And vice versa is true as well. So that's the case for China. So China's playbook in the years past was to use exports as a strategy to alleviate overcapacity in some of the sectors. But that playbook is becoming less and less viable simply because of the way the US tariffs are structured this time around. And also the EU is also considering enhancing its trade barriers to stop China from dumping exports that can no longer go to the US. So exports as a strategy is becoming less effective for China. Then, of course, you've got the usual structural issues in China, the growing population, shrinking demographics, the ongoing concern over youth unemployment, and, of course, very recently, the EV price war in the domestic China market basically continues its existing deflationary trend. All in all, China is very likely to miss its 2025 GDP growth target of 5%. Probably it's going to come in about 4.5 or 4.6%.
But how might weaker retail and industrial growth affect investment opportunities in Chinese equities and bonds? Are there particular sectors in China that could outperform despite the slowdown?
Well, it could. So it's basically like looking for a needle in a haystack. So specific companies in specific sectors could actually weather a storm better. If you take a deep dive at some of the Chinese government policies, let's take the one for its consumer goods trading program. So this is similar to what the U.S. did, the Cash for Clankers program in the U.S. Basically, China has doubled the budget for its trading program. Basically, what it means is that if you've got an old electronic appliance like a fridge or a cattle or rice cooker, or you've got an old vehicle that runs on petrol, you can trade it in using subsidies for newer contemporary models that use less energy or have got lower carbon emissions. So it's kind of like, getting people to upgrade, but also to stimulate those particular sectors, right? So manufacturers of low-cost EVs as well as electric scooters, they tend to benefit more from this kind of programs compared to the bigger brands. Okay. So we're not essentially talking about the Geely or the BYDs, but the smaller players. So there's something to look at. Prices of that kind of those kind of companies have already gone up quite a fair bit since January this year. The other niche sector, which could be quite profitable, is, of course, the premium pet food sector in China. This goes back to the societal trend of singles or, Chinese couples with no kids, and then they buy a pet, and then they tend to pamper the pet. Yeah. So one of the things they can do for the pet is to, of course, buy premium pet food. So a specific company called Yantai China Pet Foods have gone up quite a fair bit since the beginning of the year as well.
Oh, well, let's look at China's new home prices. It fell 2.8% year on year in July, narrowing from a 3.2% drop in June. But property investment is still down 12% year to date. Does the smaller drop in home prices suggest the property market is bottoming out, or are we just seeing a pause before further weakness?
Well, it's partly due to the math, right? So absolute values have fallen quite a fair bit. So any kind of further decline is, on a percentage basis tends to be smaller. So that's just how the math works. The big hope was that for the second half 2025, this will be a turning point for the property sector in China. But then, of course, Trump 2.0 happened, and we have got the existing or the current tariff war that's happening right now. So it's unlikely that we're going to see a broad-based recovery in the Chinese property market anytime soon. So, and then you've got anecdotal news, articles coming out. Earlier this year, or rather this week, a Hong Kong court ordered the liquidation of China's South City. That's, a company that was one of the biggest ones, not as big as China Evergrande, but still up there. And the company had liabilities of about 10 billion Sing dollars, and it defaulted on its US dollar bonds slightly more than a year ago. So that's still ongoing. So we could be near the bottom of the cycle, but, these are things you can only know for sure on hindsight, right? So, but, given the US and China has not come to any kind of trade agreement, and China still has got its underlying structural economic challenges, we may not be at the bottom of the cycle yet.
But for investors in property-related stocks, do you think it is a time to buy on weakness or stay cautious?
Well, that's the million-dollar question. So a couple of moving parts. So now the consensus view is that interest rates should come down sometime later this year. So the base is probably about 0.5%, 50 basis points. That's the working assumption for most analysts nowadays. But the challenge with that is, of course, the only reason why interest rates are coming down is simply because the economic situation is worsening. And obviously, in that scenario, that might dampen buying enthusiasm for property-related stocks. So, companies in the property development sector, they deal with a product which is multi-million dollars, right? It's a big ticket item. So obviously, consumers might be a bit skittish because of the wealth effect if the economic situation worsens. So I guess the smart play here is to stay cautious. But that said, there could be specific property developers, specific companies and REITs that may offer compelling valuations. So it's best to, for investors to take a read at all the research reports that's coming out from the banks as well as the brokers to kind of decipher the needs going forward.
Now, still in Asia, Japan surprised markets with a stronger than expected GDP growth in its second quarter, which was up by 1% annualized, which is supported by solid exports and even capital spending. And this marks a fifth straight quarter of expansion, even with U.S. tariffs in play. So how sustainable is Japan's growth given the global trade headwinds and potential slowdown in export demand later this year?
Well, I reckon it may not be sustainable in the medium to long term. I think one factor is that some of those solid exports are simply because of U.S. companies bringing forward their orders to first and second quarter, simply to build up their inventory before build a buffer in their inventory before the U.S. tariffs are implemented. So which means that this is just a timing issue, right? So orders that would have happened in the second half are not brought forward to the first half. There's also, one reason why U.S. second quarter inflation was relatively muted, simply because companies in the U.S. are drawing down inventory. But going forward, they're not going to have that benefit, simply because they've already run out of inventory, right? It's depleted. So we do expect the impact of U.S. tariffs to start showing up as we head closer to the end of the year. And again, not just tariffs. Japan also has got other issues. For example, it's got this huge price problem with its rice. And in general, its inflation is still higher than what the Bank of Japan would like. I think it's now at 3.4 or 3.3%. So not a great combination if you have got elevated inflation and softer growth for the second half.
Oh, so does this shift the balance of attractiveness in Asia? And could Japan now be a better bet than China for near-term equity opportunities then?
Well, I guess it's a bit of a mixed bag. So both countries have got strengths and weaknesses and where they are, and they are in different stages of the economic cycle. So the thing about, investing, right, is that it's easy to make money when times are good because even the stock price of weaker companies tend to go up alongside with everybody else. In tougher times like this, investors probably a smarter play would be to try and look at individual companies rather than countries to try and figure out if they perform better compared to their competitors. So instead of looking at, Japan and China as separate markets, I'll probably look at companies in both countries for investing opportunities.
Now, over in the U.S., producer prices in July jumped 0.9% month on month, the biggest increase in 3 years. And it's driven by broad-based gains in goods and services. And on a year-on-year basis, PPI rose 3.3%, up from 2.4% in June. What does this surge in producer prices mean for the investment climate in U.S. equities and bonds?
Well, higher than expected PPI, generally what it means is that the business costs such as, raw materials, the price of intermediate goods, all those things are inching up. And, there's going to be a feed-through process. So if businesses are paying more for what they need, then at some point they're going to have to pass the cost down to consumers. Now, the CPI numbers in the U.S. are still relatively benign. So this basically suggests that U.S. companies are, one, drawing down their aforementioned inventory, and two, absorbing much of the higher costs and the impact of the tariffs. But obviously, this can't go on forever. So at some point, the higher PPI is going to feed into the higher CPI and higher personal consumption expenditure price index. That's not good because it's going to leave less room for the Fed to cut rates, and that's generally a negative for both equities and bond prices.
And before we let you go, anything else you'll be looking at the next week?
Probably the next 2 weeks. So NVIDIA earnings are coming out on the 27th of August. Most of the big tech companies in the U.S. will announce earnings. NVIDIA is usually pretty late in the earnings calendar. So it'll be quite interesting to see if the standard bearer for the AI revolution still continues to outperform its lofty expectations.
Well, thank you so much for joining me today, Benjamin.
Well, thanks for having me.
That was Benjamin Go, Head of Research and Investor Education at SIAS. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.